Ever heard the phrase, "let your money work for you"? It sounds like a dream. The idea that money is out there somewhere, rolling up its sleeves, clocking in, and building wealth while the owner relaxes. But there's a part of the story that rarely gets told. Money doesn't work for free. In fact, it refuses to even start working unless it's handed a big paycheck first. That's the part financial advice often leaves out. Compound growth looks like magic in charts and investment books. But when the real numbers show up, the magic suddenly looks more like slow motion. Without one key ingredient, a solid chunk of money, compounding can feel more like a waiting game than a wealth engine. Think about it. It doesn't matter how clever an investor is or how early the start. Without enough weight behind that money, the outcome is far smaller than most people expect. Let's paint a picture. Daniel was 26, living on a tight budget. He skipped the daily coffee run, skipped weekend luxuries, and quietly set aside $150 every month. 10 years later, he logged into his investment account with excitement and saw $24,000. Not bad for discipline, but the feeling wasn't pride, it was disappointment. There was this sense that all those sacrifices, all that patience, should have produced something bigger. It wasn't a mistake in strategy. Daniel followed the rules everyone talks about. The problem? He was trying to roll a snowball using a single snowflake. Compounding rewards weight, not just willpower. It cheers for the wealthy, and undercapitalized investors get scolded by its slow pace long before they get rewarded. The pace isn't slow because compounding is broken. It's slow because the starting push is too light. A small snowball takes forever to grow, even on the steepest hill. That's why the first stage of wealth building feels like nothing is happening. The curve is flat, the progress invisible, and patience starts to feel like punishment. Without enough initial force, it's like trying to get a merry-go-round spinning with one lazy shove. The motion is there, but it's barely noticeable. And here's where many people give up. They think the system failed them, when in truth, the input was never enough to bend the results. Imagine standing at the base of a mountain, tossing pebbles downhill, and waiting for an avalanche. It doesn't matter how long you wait. Without the mass to trigger movement, nothing happens. That's the quiet truth hidden in investment brochures. The early years of compounding are a test of capital weight. Without that weight, the math doesn't create magic. It just counts pennies. That's why wealthy investors seem to have a head start. It's not only the amount of time they've been in the game, it's the size of the chips they're playing with. And once a portfolio reaches a certain size, the gains start looking outrageous, not because the math changes, but because the same percentage return is landing on a far bigger base. 10% on $10,000 feels like gas money. 10% on $1 million feels like a salary. That difference is the engine most people never see until it's too late. Now, it's tempting to wonder whether this means compounding is a sham. Not exactly. It's not dishonest. It's just bound by a kind of financial physics. And physics plays favorites with mass. That's why wealth multiplies faster for the rich even when they start later. Towards the end of this video, there will also be some advice on how to make compounding work even with little money. It's difficult, but far from impossible. Here's the thing. The popular advice says, start as young as possible, and riches will follow. That's a half-truth wrapped in a friendly smile. Yes, time is powerful, but only when it teams up with size. Imagine dropping a single raindrop onto a trampoline. Nothing happens. Now imagine tossing a bowling ball onto that same trampoline. It bends the surface, stores energy, and springs back with force. That's exactly how capital behaves under compounding. A small amount just sits there politely, but a hefty deposit bends the curve of growth almost immediately. Consider Warren Buffett, often used as the poster child for start early. Yes, he began buying stocks at age 11. But here's the part that doesn't get repeated as much. Over 99% of his fortune arrived after his 50th birthday. Time mattered, but the real explosion happened when his capital reached critical mass. Let's break that into numbers. Saving $100 a month and earning 10% a year for 20 years ends up at roughly $69,000. That's not financial freedom. That's the price of a decent used hatchback, which means compounding isn't purely a waiting game, it's a positioning game. Without a push toward a large base, it's not really compounding, it's just decorating a savings account. And that's the part nobody highlights in the glossy financial charts. The graph always looks like it's about to explode, but what's missing is scale. That famous upward curve feels exciting until the actual dollar amounts are revealed, and the big growth turns out to be a tiny bump on the lifestyle radar. Positioning is about getting enough mass into the system so that when compounding starts doing its thing, the numbers are actually life-changing. Without that mass, the math works perfectly, but the results stay unimpressive. It's like building a rocket. A tiny firecracker can still produce sparks, but it won't leave the ground. A rocket with enough fuel not only launches but escapes gravity entirely. In money terms, escaping gravity means getting to a point where annual gains alone cover major expenses without touching the principal. That doesn't happen by accident. It's engineered by adding as much as possible as early as possible. People often get frustrated after years of contributing small amounts because they thought time was enough. Time is powerful, but without capital weight, it's like a magnifying glass without sunlight, perfectly capable in theory, but missing the energy source it needs to work. The sweet spot is where time and size meet, and that's where compounding transforms from a patient gardener into a wild, untamed forest growing on its own. This is why the wealthy use compounding differently. Where most people slowly drip $50 or $100 into the market each payday hoping for a snowball over decades, the wealthy drop $50,000 or more in a single move and watch years of growth happen in a fraction of the time. That's not luck. It's capital leverage. Think of it like gardening. One gardener plants a seedling and waits. The other transplants a fully grown tree. One hopes to see fruit in decades. The other eats fruit next season. Both call it investing, but only one enjoys the benefits early in life. This is why bonuses, business profits, inheritances, or even tax refunds are treated like high-octane fuel in wealthy portfolios. Those big lump sums poured in early bend the growth curve sharply upward. Here's the rule time obeys. It multiplies capital, not thrift. The bigger the chunk, the sooner the curve takes off. Now, the flip side. Why do small, slow contributions often disappoint? It's not that they're bad. People obey the advice. They budget. They skip luxuries. They funnel $200 a month into a retirement plan. 30 years later, they might have $400,000 before taxes and inflation. Respectable? Sure, but it's not a golden parachute, and it took a lifetime. Meanwhile, the asset managers quietly clipped fees from those same accounts every month. The authors who praised discipline in their books didn't get paid in monthly drips. They got paid in lump sums from book advances and royalty checks. The pattern is obvious once it's seen. Small investing isn't evil, but small investing alone can lull people into a false sense of progress while secretly delaying the real breakthrough. That treadmill feeling, working and working with no sense of acceleration, comes from compounding that has been starved of calories. So the better question to ask isn't, how long will this take, but how big can I go? And how soon? High earners demonstrate the shortcut all the time. A surgeon, a software developer, or a business owner may invest aggressively for only 5 to 10 years, front-loading six-figure amounts, then let time finish the job. That $100,000 seed does more in a single decade than $100 per month can do in half a century. The strategy doesn't require being born wealthy. It's about building the skill set, the business, or the side project that generates big capital first. Once that mass is in place, compounding turns into an amplifier instead of a rescue plan. Here's a practical angle. What skill, service, or product could raise income by 20% this year? That extra money isn't just lifestyle padding, it's the weight compounding needs. Building that weight is step one. Guarding it is step two. Compounding collapses if the principal disappears. Buffett's famous never lose money rule is really a worship of protection. The wealthy shield their capital using tax shelters, index funds, real estate, and diversified income streams. They're not chasing 25% returns followed by minus 15%. They know a smooth 7% climb compounds far better than a roller coaster of wins and losses. A single drop can reset years of growth. Every dollar kept intact is a worker showing up tomorrow. That's why capital protection is as important as capital growth. But there's another compounding engine most people overlook, and it lives outside the stock market. Skills compound faster than stocks when they're stacked one after another. Learning persuasive writing, negotiation, or software design can double an income in a year. That larger paycheck is seed capital, opportunity, and a safety net all rolled into one. Almost every self-made millionaire stacked skills before stacking dividends. They invested in their ability to create value on command. For someone starting small, it can be smarter to spend $500 on a focused course this month than on an index fund contribution. That skill might raise the income ceiling for the rest of life, a return Wall Street can't match. Then, there are systems. Systems multiply everything. Hard work alone has a ceiling, but systems scale indefinitely. Rental properties, automated e-commerce stores, royalty income, subscription apps, even streamlined service agencies, all follow the same formula. Build once, maintain, collect forever. When income is tied only to hours worked, growth has a cap. But when assets and processes generate money while the owner sleeps, compounding becomes a 24-hour operation. Yes, systems require front-end sweat and can feel clumsy at first. But once they run smoothly, every dollar they produce drops straight into the capital pile, and that pile reaches critical mass much faster. Here's the uncomfortable truth. Most people never see compounding's fireworks. They're told patience is the only lever. They wait, drip money into accounts, and hope. 2 or 3 decades later, they find themselves almost comfortable, but not truly free. Compounding is honest. It only bends for bulk. A thin base doesn't compound wealth. It compounds frustration. The shift in mindset is simple. Don't just start early. Build heavy. That means cultivating skills that boost earnings, launching small but profitable businesses that generate extra cash, negotiating raises, selling unused items, cutting out subscriptions that no longer serve a purpose, redirecting every windfall into investments instead of splurges. Every extra 1,000 today matters more than the same 1,000 10 years from now. Why? Because today's dollars get more compounding cycles. So, bring it all together. Compounding dazzles only when fueled by a large sum. That sum is built faster by combining 3 engines: skill stacking, system building, and capital protection. The game has never been about time alone. It's always been about size. Once capital crosses a certain threshold, growth stops crawling and starts sprinting. Money begins multiplying quietly, powerfully, predictably. When this message clicks, it changes everything. It signals readiness to trade slow advice for intentional momentum. The first step is to assess goals and comfort with risk. Then, stop waiting passively. Use today to thicken seed money, sharpen skills, design systems, and protect the base. Because once critical mass is reached, compounding finally does look like magic. Though underneath, it's always been math and momentum working hand in hand. And one final likely mathematical combination. If this point has been reached in the video, the next move is to subscribe to this channel. Like the video for more content like this, and share it with someone who might be sitting on the slow path without realizing it. The sooner more people learn how compounding really works, the sooner they can start building the weight it needs.